I'm Paul DeNicola with PwC's Governance Insight Center, and I'm here today with Alexis Crow, who leads PwC's geopolitical investing practice. So Alexis, thanks a lot for joining me.
Thanks so much for having me.
Every so often, it's great to have you stop by to give your perspective on the global economic environment and how that's really impacting the conversations that you're having in boardrooms. And I know you've recently published your economic outlook for 2023. There's a lot of topics that you cover in your outlook, but I want to drill down on a couple today in the time that we have.
Sure.
So maybe the place to start is really around inflation and monetary policy. So inflation's on everyone's minds. The actions of central banks in terms of their attempt to tame and control inflation is a conversation with many of the clients and boards that we speak to. So I guess the place to start is, have we hit peak inflation in the US and in the Eurozone? And then what are you thinking about the actions of central bankers going forward?
Well, that's a great question, Paul. Thanks so much. So firstly, I think it's important when we're constantly bombarded by headlines to be able to differentiate between different types of inflation categories. So headline inflation, which includes the volatile food and energy prices, stripping that out, we get core inflation, of which in the United States, 1/3 of the CPI is actually the housing index, so that's an outlier there. And then we break down into wage inflation, asset price inflation, producer price input inflation. We get very different readings. And there's obviously been a huge debate by commentators, by economists, by central bank watchers as to whether or not the cause of the current inflation that you mentioned that we've experienced in the US and Eurozone and other North American advanced economies is to do with supply, demand, or a mix of both. And really what I would emphasize here is that we've witnessed some of the single greatest shocks to supply related to the pandemic and the drop of oil production in 2020, which that passes through to other commodity prices, as well as then this extraordinary shock of Russia's invasion of Ukraine to the global energy market. So really a lot of supply side drivers. We've also had, experienced the extraordinary supply chain bottlenecks, which have been easing over time. I would actually argue that we've seen pockets of demand with reopenings of the economy and the pandemic-related behavior that are starting to subside as well. So thinking back when we went through the rental car phase in 2021, airline fares as well, and some of those prices have moderated over time. What we do not see critically is this endemic wage price spiral. So thinking about the wage inflation side of things, wages significantly coming down in the United States, still elevated in some of those categories of demand, such as accommodation and food and beverage services as well. We've also seen, I think, in the Eurozone, a little bit of a later wage increase where labor has really rebargained with capital in the face of higher energy costs, which of course have been extraordinarily increased in the Eurozone. Housing, for its own different specific factors, has been an outlier to an otherwise disinflationary environment leading into the COVID-19 pandemic. And I would actually say that although many are alarmed by falling housing values at the moment, that we will probably also see values appreciate over time. So what have central banks done in response? They've certainly come under fire, and a lot of credibility has been on the line, particularly with regard to the Fed, as the rest of the world focuses on US monetary policy and the direction and the strength of the dollar. We argue this in the annual outlook that all signs are on the wall that we have reached peak inflation,
Right.
With a lot of these supply side issues starting to moderate as well.
So I'd like to get really practical for a second. As board members are walking into their next quarterly meeting, and they're keeping in mind where we started in terms of the inflationary environment, the actions of central banks, the geopolitics, the energy markets, commodity issues, all of these things are swirling for board members. What are 2 or 3 practical questions that board members should be asking their management teams as they attempt to sort of have these conversations about how economic factors are really driving their businesses?
Thank you, Paul. So I would actually say that the huge benefit of board members can be to really bring a long-term perspective to executives and management teams that are operating quarter by quarter. And so one of those, I think, that we started with is on the direction of interest rates. And where will interest rates go if the Fed plateaus at 4.75 to 5% in a federal funds rate, money is not expensive, it's not cheap, it's not free, but it's not necessarily expensive. And so how is the whole business, how are the whole finance and treasury teams predicated upon this? I would actually argue that that means that in the longer run, going 2025 out, which is the Fed's definition of longer run at this moment, that you probably will see lower for longer rates and rates coming back down 3.5%, maybe not to 2% in the US, which is a number pulled out of thin air. So that has implications for the asset price environment as well as things such as the supply of affordable housing. On the second, on the geopolitical landscape, I would really be tasking our boards to be asking their management teams on if there's any connection with China, what are the real facts on the ground here? And the real facts on the ground is that we are witnessing this technological decoupling, but that it has not necessarily spilled over into other business sectors. And that's important to note. It's also important to note that in the face of rising protectionism, such as with regard to the energy transition, that doesn't necessarily mean deglobalization or an emphasis on onshoring or nearshoring. Yes, there's the Inflation Reduction Act in the US, which is bringing a lot of investor attention back to the US. But I would actually say that these are shifting sands, but not necessarily an end to the world of globalization as we know it. Lastly, I would also say that despite even some of the reporting measures that are coming out of the SEC with regard to the environment and moving toward net zero, that there isn't necessarily a consensus by executives or by boards on moving toward net zero, particularly in the United States. I've just returned from Davos in Europe, and that is, very much the spiritual home of net zero and decarbonization. It's not necessarily in the US. And so I think there is an active debate to be had here. Beyond that, beyond the E part, is really looking to the S and the G components. These are often overlooked by management teams and boards on how they can be fulfilling these, how existing support of, for example, upskilling people in human capital and a focus on human capital in a way we've done in PwC could actually mean fulfilling the S part of the ESG criteria. And I would be looking for some of those golden nuggets that could be highlighted potentially to the wider stakeholder community.
Great advice. That's a great place for us to conclude. Thank you so much for joining me today.
Thank you so much, Paul.
So you can read more on Alexis's perspective in her 2023 outlook entitled Warmer Climes Ahead. Thanks a lot for joining us.